Hello, my name is Casey Ortiz, and I'm going to talk to you today about the relationship between accounting scandals and accounting laws. It is my theory that the accounting laws, the accounting reform of 2002, was a direct correlation of the accounting scandals that have been popping up since the late 90s. First, real quickly, I would like to go over who is affected by these accounting scandals. Most people would probably think that it is just the people working for the company, the people that go to jail, the people that get fined for committing these scandals, but it's so much more. It's the investors, the shareholders, the employees. In most of these scandals, you'll see investors lose millions, employees lose their jobs, the public loses their trust in these companies, and they're scared to invest their money anywhere because they hear about all these stories of CEOs stealing billions, and that's just a really sad thing for people to have to deal with. So I just wanted to iterate why, even though you may not personally invest in these companies, you may want to invest in companies in the future, and you need to know why this could affect you someday. These are the three scandals that I feel were the most influential in the decision to create new laws and reform accounting practices. And these weren't the only three scandals that happened in this time period. There were several throughout late 90s, namely 1998 to around 2002, 2003. And there's been scandals since. I just feel that these three were the most important and really woke up the nation as to what was going on behind the closed doors of some of these Fortune 500 companies. And I would like to start with Waste Management. Waste Management was a Houston-based company that made headlines in 1998 when it was discovered that the founder, CEO and chairman Dean Buntrock had reported $1.7 billion in fake earnings. Now, the way he did this was he falsely increased the depreciation time length for his major long-term assets, such as property and equipment. In turn, this lowered the depreciation expense of the company, which increased the earnings on the balance sheet, which made the company look more profitable than it actually was. When you make a company look more profitable than it actually is, it will increase stock prices, and people will want to buy in thinking that they'll get a bigger return. There were many parties involved in this fraud. Dean Bontrock, for one, who was the founder of the company. Also, Philip Rooney, who was the president of the company and the chief operating officer. And Arthur Andersen, which was a large auditing firm that provided auditing services as well as consulting services for its client. The way this fraud was discovered was the new CEO and management team went through all the books and internal controls and found out what had been going on this whole time and essentially turned it over to the SEC. After litigation, the shareholder class action suit was settled for $457 million, and Arthur Andersen, the auditing company, was fined for $7 million because they knew what was going on and did not report the company because there was a conflict of interest that was created when they decided to also become a consulting firm for the company because they were on the payroll. Now let's move on to Enron. Enron was a very big surprise to everyone. It was in 2001, another Houston-based company. This was pretty fresh off the heels of Waste Management. Arthur Andersen's auditing firm was involved yet again. It kind of came as a huge shock. Not only because the amount of money that was lost by innocent people, but also because of the fact that it could be seen now that Waste Management was not going to be an isolated incident like people probably thought it would be. So let's just start with the particulars. The Enron scandal lost its shareholders $74 million. This is a lot of money. Not to mention, thousands of employees lost their jobs, as well as investors and employees lost retirement accounts. And the way that Kenneth Lay and Jeffrey Skilling committed this fraud was very tricky. You could look right at the books and not really understand what you were looking at unless you knew about accounting. You were an accounting expert, and a lot of people that buy stock and buy shares in a company are not accounting experts. They look at the stock prices, they look at retained earnings, expenses, things like that, and if the health of the company looks good overall, then that's where you want to put your money. But this fraud was being committed by keeping these massive debts off the balance sheets. And the way they were doing this was by using an SPV. An SPV is like a shell corporation, if you are familiar with that. A shell corporation has been used in the past for businesses to launder money, basically, to hide their money somewhere where no one would find it. And this is essentially what an SPV is. It is another corporation that is created by the company. And if the parent company, which would be Enron in this case, does not have a controlling interest over the SPV, they don't have to consolidate their financial statements, which means they don't have to disclose the amount of debts and losses associated with this SPV, which really essentially isn't real in the first place. It's just a place to hide what is actually going on. And they would appoint their top executives as the principals of these SPVs, which not only creates a conflict of interest, but also makes them a guilty party as well, because they know what's going on and they aren't coming forward. As a result of this fraud and the uncovering of this fraud, stock prices of Enron dropped from almost $90 in only a couple of years, and probably almost that much overnight from the time that the fraud was discovered till it was, came out the next day. As a result of the scandal, Skilling and Lay were both sentenced to 24 years in prison. Kenneth Lay died before he could serve his sentence. Skilling did serve his sentence, and Arthur Anderson, once again involved, once again a consulting firm, once again on the payroll, was fined for falsifying accounts. The last scandal I want to go over today is WorldCom, also known as MCI. This scandal inflated assets by $11 million, and it was done in such a simple way that it's kind of hard to believe that nobody knew. Nobody turned these people in, because it wasn't sneaky like Enron. It would have been right in your face. If somebody had looked at the books and had any accounting knowledge, they would have known immediately what was going on and reported Bernie Ebbers, which was the CEO at the time, for committing this fraud. What he was doing was capitalizing cost rather than expensing cost. When you capitalize a cost, you can stretch that cost out over a period of time. Say you buy an asset that's going to last you a long amount of time, you can stretch that cost out by periods until the asset is no longer valuable. When you expense a cost, say I buy paper for the copier, that would be an expense. You take it out of the money, your books, right then. There is no stretching it out. However, Ebbers was taking everyday costs and capitalizing them, which was deflating the expenses basically and inflating revenues, making it look like the company was making more money than it actually was. This scandal resulted in investors losing a total of $180 billion. WorldCom had to file for bankruptcy, which was the largest bankruptcy to ever be filed to date. The CFO, Scott Sullivan, WorldCom CFO, was also found guilty of cooking the books, basically, and he also was fired as the CFO and stripped of his CPA license. This is the scandal that really put emphasis on corporate government and internal controls. Corporate governance is essentially the law of the company, the rules, the procedures, the practices, all the things that the members of the company must abide by and follow to protect the interests of the stakeholders. Now, stakeholders are not just shareholders. Stakeholders are shareholders, employees, management, anybody who has a stake in that company and can get hurt, financially or otherwise from something happening to that company. But WorldCom was the straw that broke the camel's back. This was the thing that was needed to pass the Sarbanes-Oxley Act of 2002, which was the largest accounting reform since the 1930s following the Great Depression. So I just want to touch upon a few of the sections of the Sarbanes-Oxley and explain how they correlate directly with the things that happened in these different scandals and how they correct the mistakes of laws in the past that did not cover everything that could have been covered to leave interpretation to the law. First, we'll start with Section 302. Section 302 deals with corporate responsibility and financial reporting. Simple enough. This section ensures that everything is double-checked, internal controls are used, corporate governance is in place. This accountability can ensure that people won't be hurt by things that happened at WorldCom like that again, because corporate governance or the lack thereof is one of the biggest problems there was with WorldCom. Somebody had to know what was going on. Even though nobody else stepped forward, nobody else was punished, somebody else had to know. And if they didn't know, it shows a big hole in the internal control process and the corporate governance process, because internal controls say that everything gets double checked, everything has two sets of eyes. So if somebody is trying to be sneaky, somebody else can come behind them to catch them. Now we'll look at Section 401. Section 401 deals with off-balance sheet liabilities, obligations, and transactions. If you'll remember in Enron, all of those transactions were off-balance sheet, so Enron did not have to report them in their financial statements. This section says that all financial statements will include off-balance sheets, liabilities, obligations, or transactions of the company. Next section we're going to look at is 404. 404 deals with the company's internal controls. Just like we said before with WorldCom, one of its biggest problems was its internal controls. And really all of these companies that we mentioned so far, and most of them, people were working together on this to commit these scandals, and if all the proper internal controls were used through every step of the accounting process, somebody would have caught it along the way. Now we're going to talk about Section 409, which deals with significant changes in financial position. If you notice, I did add some graphs of Enron and WorldCom's stock prices over the years. Well, in Enron, what happened was the people that were in the know, the people that were committing the scandal, before the scandal broke, they sold all their stock, which is basically insider trading, and left the other people who had no clue what was going on to lose all this money. But this section is also to make sure the companies let people know what is going on and not just letting them, their shareholders, and not just letting them be blindsided by the news the next day and not know what they're going to do, having lost all this money, not having time to put a plan in place. So it's making sure that these companies let the public know as soon as they know, as soon as possible, so that people can have time to make adjustments, make a plan, and get everything together before everything falls apart. The last section is Section 802, and it just outlines the penalties and fines for committing any type of fraud or presenting false information in financial statements to try to steal people's money. This section imposes penalties or fines for up to 20 years imprisonment for altering, destroying, mutilating, concealing, falsifying records, documents, or tangible objects with the intent to obstruct, impede, or influence a legal investigation. This section also imposes penalties of fines or imprisonment up to 10 years for any accountant who knowingly and willingly violates the requirements of maintenance of all audit or review papers for a period of 5 years. With the Sarbanes-Oxley also came the Public Company Accounting Oversight Board and protection for whistleblowers. In the Enron scandal, the whistleblower was Sharon Watkins. She did not lose her job, but there was protection offered to anybody who found scandals, found any fraud, and wanted to come forward but was scared of repercussions of their job, being harassed daily at work, etc. The SEC felt it was important for people to feel like they could come forward because, like I said, in all these scandals, nobody came forward, and that's probably why. They felt like they had nobody. They felt like they had no protection, and their job would be gone, and everything would be gone if they tried to come forward or report any of this fraud. Now, the Public Company Accounting Oversight Board was created by the Sarbanes-Oxley to implement the rules of the Act. They perform tasks such as registering accounting firms, inspecting register firms, setting auditing standards, and determining what non-auditing services are prohibited. Like I said before, Arthur Andersen was a consulting service for many of the companies they also audited for, putting them on the payroll, creating conflict of interest. So that would be a non-auditing service that would be prohibited if you were also acting as the company's auditor. It's reforms like this that show that the government, with the Sarbanes-Oxley Act, was taking into account all the things that had happened so far and trying to make them right and trying to put laws in place that showed that they were on top of it and they were going to put a stop to all of this corporate scandal that was happening all at once. Because just a year prior to WorldCom, the Sarbanes-Oxley was sitting in legislation, but it wasn't being passed because the House and the Senate could not agree. That's why I say WorldCom was the straw that broke the camel's back, because after WorldCom happened, just a few months, the Sarbanes-Oxley was signed into law and being implemented into every accounting and auditing firm across the nation. I personally find this topic very fascinating, and it really makes you wonder, if crimes didn't happen, would there be laws to protect you against these crimes? I don't believe that anticipatory laws can work as well as laws that are created after the crime is committed, because people are inventive. They come up with new ways to do things all the time. And with technology the way it is, I really wouldn't be surprised if in another 10 years we see another accounting reform or corporate reform. Because with the growing technology, they're just going to come up with new ways to commit fraud. And I just find it all very fascinating and interesting, and really am excited to see how the profession and the field grows and how the laws adapt to everything that is changing around us. Thank you very much for listening, and have a good day.